presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for January the 17th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. Let's start with the markets today. I'll talk a little bit about the Fed. What is the Fed doing? What are they thinking? The market where we are, looking at the economy. Then a little quick update on technicals in the week ahead. This is a holiday shortened week, as everybody knows. Yesterday, markets were closed for ML King Day. So we have a holiday shortened week, but we did see the markets come up nicely coming into the holiday. I think we're going to see some kind of little bit of a pullback, backing and filling. It will depend if we can hold support or not. We've gone through the 200-day a couple of times, and when I take a look at the charts, I will talk about those. But then we've fallen back. We did it, came and kissed it in June, went through it in December a couple of times, then came back. Now we're through it again. We'll take a look at the charts. But let's look at the Fed. The probability is at the next meeting, they're going to raise interest rates by only 0.25%. That is the expectation, that 0.25% or 1/4% is the expectation. Anything above that, 50 basis points, is down to about, we're looking at somewhere around a lot less than 10% probability. So 25 basis point, 1/4% increase in February, another 25 basis points in March, then we think the Fed is done. But the Fed has got to prepare everybody and let them know that they're going to stop raising interest rates. As soon as the market gets the confirmation that the Fed is hitting the pause button on raising interest rates, I think that will be where we could see an acceleration in the market. But as I said, we've got two more interest rate increases expected, one in February and then one in March at the next two meetings. Until we get past those, I think the markets are going to continue to have a bias to the upside, but a lot more volatility. We're also seeing some of the more hawkish members of the Fed. Those are members that want to keep interest rates, think they say that the Fed has more work to do. Our terminal rate seems above 5%. Those members are right here. Barking, Logan, Kashkari, George, Bullard is one of the most hawkish. You can see that they're voting members here in 2022. In 2023, three of them go off and they're not voting members, so they do not vote to increase or decrease interest rates. They're a member of the FOMC, but not voting members. Those rotate. We do see two more, but they're less bullish, hawkish members do become voting members. Then in 2024, there's only one or two members that are sort of hawkish that'll be there. Rest of them are pretty, who say that closing in on terminal rate, a pause would be appropriate. Those are the comments, these governors right here from the FOMC. So the FOMC is moving from a more hawkish composition to a more dovish composition. Looking at the markets, we're seeing the markets, the equity market has bottomed well before GDP, payrolls, and S&P and her housing. You can see that S&P, you can see the market bottomed here. The S&P did not bottom until the market bottomed long before earnings. Here's the S&P earnings. Here's, we're looking at GDP and delinquencies. You can see that. You can see payrolls did not bottom, continue to go down. So you see this during the S&L recession. You can see in the dot-com bubble. You can see when we had the financial crisis. The stock market, ISM numbers are usually a good indication. That's what I like to see, but you can see that they are a little bit ahead of the stock market bottoming. But usually the stock market bottoms, then we see payrolls continue to get worse, housing starts bottom 2-3 months later, then we see GDP bottoming, then we see earnings bottom. So these things continue to worsen while the S&P starts to go up. So that's the way it usually works. Looking at the economy, a pattern, as if you saw these seminar, we talked about these a lot. I expected inflation to peak out somewhere in June and July. We did. Now I expect the rates to pause going up, the Fed to pause somewhere in the first quarter of this year or by March. And if they do, that would be the end of interest rate increases. Then everybody will start talking about the recession. How bad is it going to be? Is it going to be a shallow recession, deep recession, no recession? No one knows the answer to that. I'm leaning more towards a shallow recession or maybe a soft landing, which everybody has discounted as not a possibility. We saw earnings today from Goldman and for JP, and they both set aside large amounts of money for loan losses during the recession. If that doesn't happen, they bring those back and those go to earnings. So I think everybody's preparing for the recession, but it will not be as bad. Everybody's looking at earnings and suggests that home prices have rolled over. This is the shelter index, but you can see home prices have already peaked and have started to come down. But you can see that inflation, that is shelter, is still going up. We think that is going to roll over too, and that'll be good for the inflation market. Don't forget that if you do want to go and get the daily edition of Market Wrap, you can go to the App Store and just type in Market Wrap with Mo, and just type this in, and you will get the free app where it'll be on your phone. You'll automatically be downloaded the daily broadcast, 1 hour broadcast that I do with some great guests, and you can listen to it anytime at your convenience. Looking at the technicals, 10-year interest rates, they peaked here. That was in October of last year. Then we've seen rates come down. We hit 4.33 as a high, and today we are at somewhere around today we closed at 3.53. So we've nearly come down nearly a full point from this peak to where we are now. So interest rates in the market have already peaked. Even though the Fed is going to continue to raise rates, the market peaked last October. Market was raising rates before the Fed was. Fed caught up. The market always leads the Fed, and this is what the market is telling us, that the rates have peaked. You look at the S&P, we got here close to the 200-day moving average. We got here close to 200-day, and this was in April. This was in June. In August, we got up there, failed, got up here, failed, and came down hard. Then we got up here and failed and came down hard. These are the failures at the 200-day moving average. Then we got here in December and then twice and failed, and the market came down a little bit. Now we're back above the 200-day moving average, which is at 39.78. We closed at 39.90 today. If we can hold this and go sideways a little bit here, then we can get up to this 4,100 resistance. And if we can get above 4,100, there's this tiny gap right here, which is right around 4,200. And we could get there by the end of the spring. That's technically what we're looking, as long as we do not fail where we are right now, the 39.90. If we do not hold the 200-day moving average, then we go down again. If we can hold the 200-day at 39.78, then we could have a nice move to the upside. Looking at the weeklies, again, resistance at 38.63. That's support now. Next resistance at 4,038. We are at 39.90. If we can get above this, this is the 50-week moving average, this blue line right here. If we can get above that, that would be a good sign. Nasdaq showing some signs of life again. Seems like we've got wave 1, wave 2, and we are in wave 3. We're above the 50-day moving average, closing today at 11,000. Nearly 11,095 is where we closed. If we can get above 11,500, that's going to be critical. Why? 11,600 is the 200-day. But even before that, if you look at the weekly, these dot plots, if they're above the market, this is the market. These are the dot plots. If the dots are above the market, it's a bearish market. As you can see, that this was, we've been so many weeks, the market has been in a bearish trend. But now we're getting very close. Somewhere this market is around 11,472, my dot plot. The market closed at 11,100 today. So another 300 points, 400 points, if we can get there, that would be very nice. And same thing, 200-week moving average, 11,400. So 11.5 becomes critical resistance. If we can hurdle that in the Nasdaq, I think that would be a confirmation for me that this bear market is over. We've made a bottom. I already think we have, but I want to get more confirmation before I put the rest of the money that we took off the market, a little bit of that at the beginning of last year that I'm still waiting to put back into the market that I have not. We bought some bonds when there's some great rates out there in the last quarter of last year, but now is time to take a look at the markets. Oil, I think, is $70, right about there, is the bottom in this market. And I think I wouldn't be surprised to see 90, 95 on the top. So we're going to stay in this range of about 70 to 90, depending on how the reopening of China goes. That's going to be the critical phase as they hit their COVID peak and start to come down, which will take a few months for them to hit herd immunity before we get there. But I think oil has $70 because that's also where they start buying oil for the petroleum reserve, strategic petroleum reserve. The government starts to buy oil. That supports the oil market. Gold, as I've mentioned, looks like that 1618 low that we made at the end of last month looks like a low to me. We got sliced right through the 200-day, 50-day, and now we're up. But looks like today we made a double top right here. Last Friday and today, the high was 1931. A pullback up to about 1960, 50 to 60, I-60, maybe even 70. Somewhere will be a fourth wave pullback. I think that's a great buying opportunity right here in gold. I think gold could continue to move higher on a multi-year high as interest rates stabilize, the dollar has peaked, which is good for emerging markets. Again, don't forget to sign up to my Market Minute. You'll get my weekly newsletter absolutely free simply by going to Compak. And next week, I'm going to do a 2-hour webinar on the 24th. If you want to attend, just go to compak.com and they'll say webinars and you can register. That's next Tuesday. I will not have a YouTube update next week, but I will do a webinar. If you want to attend, go to compak.com, compak.com, and register right now and you can ask questions. I will be more than happy to ask those questions for you. Also, if you need help with your portfolio, give us a call. We'll be more than happy to develop a portfolio for you. 800-388-9700, 800-388-9700, or just go to compak.com. Have a wonderful week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.